Smith & Wesson is by far the most well-known gun manufacturer in the United States. They make products such as pistols, revolvers, long guns, and accessories like hunting knives, etc. And personally, my favorite gun manufacturer, period. Current share price of $17.85 with a massive collapse of almost 30% within the past just couple days at earnings because they just completely missed on their earnings. Is this $17.85 a good price to buy based on their fundamentals? We're going to find out. Howdy everybody, today we're going to be analyzing Smith & Wesson Brands Inc. They are a gun manufacturer, and whether or not your opinion about guns is positive or negative, that's not the point. I am here to analyze stocks, I am here to analyze companies, so that way we can analyze to see if they are a good buy, so that way we can take part in their profits. And when they get wealthy, we get wealthy. So let's analyze Smith & Wesson. Starting off, surprisingly, they do have a dividend yield of 1.45%, which ends up being around 8 cents a share for an annual payout of 26 cents. Payout ratio in regards to the net income of 6.06%. No 5-year growth rate. Dividends have grown for 1 year consecutively, which, by the way, guys, I think they just issued their dividends last year. So they're already at 1 year growth, which explains why they don't have a 5-year growth rate, because they haven't been giving out dividends for more than 5 years. So makes sense. Ex-dividend date of December 15th, payout date January 3rd, so essentially New Year's. So starting off the year, you're already going to get paid by Smith & Wesson if you choose to buy into this company. And they pay their dividends quarterly. Now coming over here to the calculator, we got the ticker symbol SWBI, share price of $17.85, PE of 3.29 with a market cap of $858 million. Guys, this PE of 3.29 is absolutely gorgeous to see. We would like to buy anything under 20, and the fact that this is at 3.29 tells us a lot that this is very much undervalued. However, we do not want to buy into a company that is in total debt, or that's issuing shares, or that they have negative cash flow, etc. So just because we see this as a good starting point does not mean that it is a buy. Now, starting off with the growth assumption, I'm going to assume a growth assumption of 25%, and actually have two reasons for this. First of all, the revenue growth year over year on Seeking Alpha, it is at 35.85%. The forward is at 3.34%. So there's a massive discrepancy here. However, there is one more measure that I really do need to show, because this one could be the determining factor to if Smith & Wesson actually gets bigger or completely disappears from the face of the earth. And this is actually the second metric that I really wanted to show you guys. This is a map of the United States, wherein the green is states that have issued constitutional carry in their state, and as you can see, the blue is shall issue. So any state that is in blue must issue constitutional carry license. And as you can see right here, majority of the states are either blue or green. Very little of them are may issue or no issue states. So the trend for constitutional carry for gun rights is actually increasing, believe it or not. So this is the reason why I am actually going to assume a growth assumption of 25%, because a lot more states are issuing constitutional carry, a lot of states are issuing shall issue concealed carry licenses, and we're heading in the direction when it comes to guns in this country of just constitutional carry and less gun regulations. So it's actually really good when it comes to Smith & Wesson. That's why I am putting them at a 25% growth rate. Now coming over here to the metrics, we got the net income. 5 years ago, $128 million to $252 million. Guys, there's an increase of 174%, which is massive. Now, obviously, something to point out. 4 years ago, it was $20 million. 3 years ago, it was $18 million. And 2 years ago, it was negative $61 million. I don't necessarily know what caused this, but regardless, it's still something to look at. Right now, this metric, while we are positive by a significant amount in this current year, it is still something to look at when they have negative net income like they did, or even barely positive net income as they did 4 years ago and 3 years ago. Next, we got free cash flow. 5 years ago, $88 million to $293 million. Guys, that is an increase of 70% with an average 5-year free cash flow of $107 million. As you can see right here, something similar occurred to the free cash flow in regards to 4 years ago and 3 years ago, where it just wasn't that strong. And then last year, boom, it just completely exploded. I have my guesses, but again, something to take a look at. I don't necessarily know they might be able to continue this, but again, this is just something to look at. However, they are positive by a significant amount, and their 5-year free cash flow is a pretty decent amount. Next, we got the revenue. 5 years ago, $903 million to 1 year ago of $1.1 billion. Guys, that is an increase of 4.73%, which is just really, really good. And again, 4 years ago, 3 years ago, 2 years ago, it just steady decline. And then out of nowhere, boom, it just completely beat it again. I don't necessarily know why this is the case. Something to take a look at. Next, we got the total debt. And this is one of the most important metrics to look at because this tells you whether or not the company is able to survive a recession or a depression. Companies that have less debt are less susceptible to go insolvent and just completely phase away from the game. So yes, we want a company that has a significant lower debt. As we can see right here, 5 years ago, in total debt, they had $218 million, and currently they have, guys, look at this, $44 million. Guys, that is a decrease of a massive 387%. I have never seen this. And guys, this is what actually got me to analyze this company, because when I saw this debt, I was just like, how do they have such little debt? That is absolutely incredible to see. They just completely destroyed their debt. In fact, they have more free cash flow than they do debt. They can essentially pay off their debt with the free cash flow in 1 year, which is just absolutely crazy. This is one of the main reasons why I actually am falling in love with this company right now as it is. Next, we got the shares outstanding. And again, we want this to be going down because this tells you whether or not the company is diluting you. You do not want a company to be diluting you as the investor. You want the company to be buying back shares. And Smith & Wesson, 5 years ago, 54 million shares to today of 48 million shares. That is a decrease, another positive fundamental of 11.59%. Guys, they are buying back shares like there's no tomorrow at more than 10%. That is crazy, at almost 12%. This by far, the total debt and the shares outstanding are already selling this company for me. And lastly, we got cash and equivalents. And as of today, they have $159 million in cash and equivalents with an average cash and equivalents of $91 million. They could even pay their debt with this cash and equivalents that they have. They don't even need to have debt at this point, which is just crazy to think about. That gun manufacturer can essentially just have zero debt by either paying it through their free cash flow or their cash and equivalents that they have on hand. That's just crazy to think. And with all of those metrics, we get the target share price of $43.04. Adjusting for debt, however, this actually goes up because, I mean, they just have so much little debt. It's crazy. They have more cash than debt. So obviously this will go up to $46.34. With a margin of safety of 5, 10, and 15%, we would ideally like to buy this at $44.03, $41.71, and $39.39. Guys, the current share price is $17.85. Right now, my required rate of return is 8.5%. My growth assumption is 25%. Maybe you don't agree with this. Maybe you think that maybe I'm wrong, right? And maybe you think that the growth assumption is 5 or 2 or negative 25, right? I suggest if you don't agree with my numbers, you go into my discounted free cash flow calculator video, download the calculator, you make a copy, and you make your own assumptions yourself. However, I would like to do something. The fact that this is 17.85%, and these numbers are based off of an 8.5% required rate of return, I would like to see what kind of required rate of return it would take to get to this 17.85%. And by altering the required rate of return closest to somewhat match this share price, guys, the required rate of return that I actually have right now is 16%. This is saying that with the current share price, you are going to make, if the company does good, right? If the company does good, you are going to make a return of 16%, which is absolutely massive. The market does around 7 to 10. So Smith & Wesson by itself, and again, they don't have really bad metrics. They do have a little iffiness when it comes to their net income and free cash flow, but aside from that, they're little debt, they're buying back shares, and they have enough money to pay off that debt. So yeah, I honestly believe that this is here to stay. And with this current share price, you are pretty much going to make around 16% return, which is just crazy to think about. But as y'all remember, they also do pay a dividend. Now let's actually see if they're even able to afford this dividend. As y'all remember, the annual dividends per share is about 26 cents, which means that every single year they pay around $12.5 million in dividends. After that, they are still left with $94 million in their free cash flow, which is just massive, which ends up being around 11.77% of their payout ratio in relationship to that free cash flow. So they are able to pay this dividend like there's no tomorrow. All in all, guys, if you do not care about guns, or if you like guns, I'm telling you right now, this is a pretty decent company to take a look at. I'm not even like, do your own research, read the 8Ks, read the 10Ks, and make your own assumption. Looking at this from a 10,000 foot view, this is a screaming buy right now. And in fact, I may even add it to my portfolio tonight and make an order for it tomorrow. I am that serious about it. I want to buy this company. But that pretty much does it for this episode. Like if you like, comment, subscribe. It really does help here with the algorithm on YouTube. You can follow me on my new tech sites of BitChute, Odyssey, and Rumble, where in addition to my stock analysis and crypto videos, you will get exclusives on those sites only. Alright, so with that said, peace out and be on the lookout for the next stock analysis video.